Daniel, please.
Thank you. Get my slides to work. There you go. Okay, I'm going to take you through the uranium market. I'll take you through Africa as well and why Africa is a great investment if you like the uranium market. How does this thing work? Thank you. There we go. Okay, so GoviEx, we're an Africa-focused company. Why? Because 8% of the world's uranium has been mined out of Niger since the early 1970s. Africa are number 4 and 5 of the world's uranium-producing countries, areas in the world with Namibia and Niger. One of our benefits and what makes us stand out from our peers is 2 of our projects are already mine permitted. They took 4 months to do that in Niger. If you're looking at similar projects in Canada, it'll take you 10 years to get to the same place. And with the new change to the law there, Bill C-69, that's probably going to add another 2 years to their process and make it even tougher. We've got a really large resource. We've been in the country for a long time. We're all old hats at Africa, and we've got a strong shareholder base. So here we are in Africa. So Niger, Zambia, and Mali. We stopped all our drills back in 2013. We could substantially increase our resource base. We felt that as we already had 21 years of mine life in Niger and 11 years in Zambia, there was no real point in making these resources much bigger. We had to de-risk them rather and focus on getting them towards production. Why Africa? As I said, in Niger particularly, 60 to 70% of that country's exports every year is uranium. Their budget is reliant on the uranium market, and those uranium projects are there. The key for us is that one of those major mines is due to close in the next couple of years, so they need a replacement. We're the next in line to be that replacement. The other advantage in West Africa is you've got ECOWAS, and more importantly, you've got OHADA. You have a standardized business law that covers the whole of West Africa. So you have a government that's very... We've highlighted this more recently in a press release that we put out where the government was willing to convert a debt, an outstanding debt from 2007 with us, into equity in the project. They want our project built. They're very keen to do that and are very supportive of where we go. And these are stable governments in mining jurisdictions. They're also very safe from an operational point of view. We've been in Niger since 2007, operating on the ground, never had any issues. All right, if you're going to invest in a GoviEx, you'd have to invest in, understand the market, and I think that's the key driver here. This is nuclear generation all the way back in time. What it shows is the massive ramp up that you had initially in the US and out of Europe as everybody wanted to get free of oil. That was then impacted by 3 Mile Island, then Chernobyl, which slowed everything down. But the big dip really came through in 2011, which is when Fukushima happened. Here's my pitch for safety. The total deaths related to nuclear accidents is officially 35. If you use it statistically, it's 4,000. So only 4,000 people have ever been impacted by nuclear accidents globally in the world. More people die in less than half a day due to emissions pollution in cities. So it's a very safe industry. What you're seeing there is a real pickup, though. You've seen nuclear generation back to pre-Fukushima. What Fukushima did is it shut down 16% of the world's production out of Japan. You saw a decline in production coming out of the European, German states, and you saw China slow down its development. China put phase 3 development back into track after they did a safety review, and Japan is restarting its reactors. Both Japan and China are targeting about 20% of total generation coming from nuclear. What has also been changing is an increasing understanding. I certainly think there's a perception. When you're seeing pro-nuclear marches in Germany now, there is an increasing understanding that nuclear has got to be part of the clean energy play. You cannot just do this with wind farms and solar panels. In fact, the renewable industry consumes 17 times as much equipment for the same energy power. So if you want to replace energy, you have to have 17 times as many mines to have solar panels or wind farms. They also require 450 times the area as a nuclear reactor will for the same amount of energy. But the key here really is 2 pieces of work that was put out. The Harmony, which was a piece done by the WNA, showed that to get the clean energy requirements of less than 2 degrees by 2050, you had to have 1,000 megawatts of power being produced from nuclear. One of the benefits of nuclear is it puts a lot of energy out very quickly and can be built very fast in relation to the scale up on renewables. What was interesting is that the United Nations did a similar review, but in a different way, and came back to exactly the same result, highlighting the complete need for nuclear. And that is why also you're seeing the development of the small modular reactors going forward now. These are down from 1.2 gigawatt reactors down to 10 megawatts, their ability to fit in smaller grids and generate. These are cheaper, easier to build, and actually a lot safer as well. The other point I'd make on that slide as well is the one thing China is doing as well is bringing down construction timelines. It's getting quicker and cheaper to build reactors by completing the same reactor over and over again. Okay, energy demand going forward, energy demand, whichever one you look at, whether it's BP, this is Exxon, you look at IEA, people are consuming more and more energy. Despite many of the Western nations now trying to reduce and be more efficient, it's not really making a difference. We just want more and more things that use energy. Look at EV cars, for example. So there is more and more demand, but what you're now seeing is certainly the developing regions, China, India, and Africa, demanding more and more need for nuclear. You're seeing the Russians particularly and the Chinese actioning in on Africa. The Russians are very strong in Zambia, like, for example, where they're looking at a build, operate, transfer on the development of reactors to get them into play. This comes back to a geopolitical issue, which is increasing angst between the US, Russia, and China on who controls the nuclear industry globally. From a supply side, so you've got about 2 to 4% on the demand side growing out. The supply side's interesting. Blue line is 2011, which is when Fukushima happened. Unfortunately, because of the long-term contract structure that's out in pricing, supply of uranium actually accelerated, even though the demand for it was declining. Also, it's a mining industry. We take a long time to turn these things around and make an impact. But what happened in 2017, really 2016, 2017 is really what's driving the market now. The Kazakhs went from volume to being value. They've realized there's no point in just churning this material out. It's actually put out less, you'll actually make more money. But they are very flexible. These are the fracking guys of the industry. So they've cut back already 20% of where they were producing. But the key was actually Canada. That big jump in 2016 was actually the old Cigar Lake coming back in. That was the one that, when it shut down in 2007, prompted the price to go to $130 a pound. Having spent over $1 billion, they finally got it going again. What they then had to do was shut their other mine, which was the McArthur River mine. So where you are at the moment is a duopoly. You've got your OPEC player, which is Kazatomprom, who's willing to flex up and down on price and production to keep the market stabilized. But more importantly, you've got a market maker now in Cameco. Cameco will keep that mine, which produces 10% of the world's production, off market until they can get their contract prices back to $50. Contract price at the moment, just over $30, and the spot price is at $25. So they've put the market into deficit. What they are now doing is buying about 20 million pounds of metal from the market, drawing down inventories to meet their contractual requirements. So they're squeezing inventories and they're putting the market into deficit. Going forward, you've got about 10 to 20% of world production closing down as old mines come to the end of their resource life as well. Nothing can replace those projects at the current price. You need a much higher price. At the same time, you've got that demand position going forward. Secondary, this is about 20% of total supply. Secondary is also declining. Why? Because governments are running out of things to sell. Also, the enrichment capacity that meets a lot of this need has declined substantially as well, and therefore this material coming out of here. So over that period of time, that is another major mine over the next 5 years that needs to come in just to replace what the secondary market was providing and is disappearing as well. So you've got production coming off, secondary coming off at the same time. This all needs to be replaced. The other problem that you have out there is during the peak time, 2007 through to 2011, about 80% of material was sold under contract. The spot market is between 20 and 40 million pounds. The total market is 190 million pounds. These contracts are unwinding at the moment. So you now have material coming out of the spot market and out of inventory going into new specialist vehicles that are investment vehicles. You've got Cameco in the spot market buying metal to meet its contractual requirements, and you've got all the major contractors sitting there running out of contract. They're going to have to start filling. And you've got Cameco saying, I won't put in production to meet those contractual requirements unless you give me a $50 contract. Production coming off that needs a much higher price to meet those needs. So that is why we're all really positive about where the uranium market goes. There's another issue at the moment, which is in the US. It's a trade issue, no surprise. Section 232. Two of the US producers have demanded that US utilities consume 25% of the material consumed got to be mined in the US. That means 12 million pounds. They only produce 1 million pounds. So at the moment, we're waiting for that decision to come out of the White House. We do not know which way this one will go, but what it has done is reduce the amount of buying from the US utilities as they await what happens. Whatever happens, we will get clarity for the US utilities and expect them to come back into the buying market. What they're doing now is pulling their inventories down at the same time. So where does that put us in the last minute that I got? Basically, we are a development company. Our intention is to get away our Madaouela project. It is fully permitted. That would follow our Mutanga project, our Madaouela project in Niger. It's right next to existing production. All the infrastructure is there, people, power, roads, water. It's right next to the existing Areva mines, which are due for closure. It currently is a $360 million build, $24 cash cost. We're very much focused at the moment on reducing the operating costs and capital costs here. We're making some major steps forward on technology to reduce these costs on both sides. We're already working on the debt financing package here as well. Obviously, that's been slowed down by the spot market at the moment, but it's already in play. We're looking at an export credit-backed facility to go in there. One of the benefits that we have, unlike many of our peers, is we have a second project, which is already permitted. Most of our peers only have one project. This is Zambia, already permitted. Massive, 140 kilometers strike length here. Almost the same cash to all-in costs as our project in Niger. We have a management team. Interestingly, of all of the total employees in our project, only 4 have non-African passports. Everyone else is a local for their project. So very much the way we operate the company. I'll go through our board because I'm running out of time. That's our corporate structure. We have a debt on the balance sheet at the moment, but that will go very soon. That the government is going to convert into equity in the project. It implies a valuation for our Nigerian project of $145 million alone for a company whose total value is only $50 million. So a lot of value there. Very liquid. We trade well over 1% of our free float every day on the OTC and the TSXV. We have just done a cash raise. We're cashed up at the moment. No issues there. But this really is the last slide. This is where the developers are valued and where the producers are valued. There's a re-rate. We are one of the only companies on the right-hand chart that can actually go from being a developer to being a producer. In the last bull cycle, the total sector went up 2,000%. The two outperforming shares were Energy Fuels, who went up 4,000%, and Paladin, who went up 10,000%. Why did those two stand out from everybody else? They were the two guys that went from being developers to being producers. The rest of the sector basically went up in line. So really, that is the story. The 3 of the biggest transactions also were in Africa in the last cycle. So Africa is a favored place when people actually want to control the uranium production. And that's it, really. Large resource, permitted projects. We like the uranium market.